Hello. So today we are going to focus on this model. This is called the circular flow of income, and it demonstrates a simplified version of an economy. And what we're going to look at is how money is circulating around this economy when it moves from households to firms and from firms to households. It's a really good way for you to start understanding how an economy works on a macroeconomic level. So let's start with some basics. So, say for example, we start with a household. So in the UK, there's about 28 million households in total, and those households provide certain things to firms. Okay, they provide these factors of production: land, labour, capital. There's also an intangible factor of production called enterprise, okay? But let's stick with the more solid examples here: land, labour, and capital. So those are the factors of production that are provided from households to firms. Now, in response to those factors being provided, firms will pay for those factors. So these are called factor payments. They will pay for the provision of these factors of production, and they pay in this model here. So we've got the payments that come from the firms back to the households in return for the factors of production. And that can be broken down into rent, normally paid for land, wages, normally paid for labour, um, interest and profit, which is normally paid on capital. Okay, so let's think about this. On this side of the economy, we have households providing factors of production to firms, and firms paying for those factors of production. Okay, now if we look at the other side of the economy, we can see on this side of the economy what's happening in the money that households earn from selling their factor payments is then spent on this side. So that's spent in the form of consumer expenditure or consumer spending, consumption, what we call that as part of aggregate demand, right? And in return for that consumer spending, firms provide goods and services to the households. Okay, now this is a very simplified model, isn't it? But it gives us a basic understanding of how economies work. Now, next, we can look at this in terms of three areas, in terms of three different ways of measuring the size of that economy. So the first thing we can do is we look at the output method. Okay, the output method is very simple. Okay, it's measuring the value of goods and services that are provided by firms to households. Okay, also known as GDP, gross domestic product, the total value of goods and services provided by firms in an economy. Okay, so we've got the output method that we call it, and that we can use to measure the size of that economy. We can also look at the expenditure method. Okay, this is where we calculate the total amount of consumer spending in the economy. Okay, which of course should be the same as the goods and services, right? So they should equal the same amounts. Now, next, we can also look at the total amount of money that is paid in factor payments to the households by firms. And this is what we call the income method. So if we were to highlight these three, we've got expenditure method. We'll use a letter O. So the output method, we'll use a letter O to signify that. We've got the expenditure method. We'll use the letter E to demonstrate that. And we've got income method, where we're going to use the letter Y to demonstrate that. So we've got three different ways of measuring the size of this economy. Okay, obviously this can't be quantified. Okay, because it's impossible to quantify this. In fact, how do we quantify the factors of production? Well, we quantify them on the basis of how much is paid for them. So we do that over here. Don't forget, income method, output method, and expenditure method. Now, that's the first step in this concept, but we're going to add one level of sophistication here as well. Okay, and that level of sophistication is based on these concepts over here. Because not only can we have this simplified model in the middle, but we can also have a look at, well, sometimes money is injected into this circular flow of income, and sometimes it is withdrawn from the circular flow of income. Okay, and let's look at some of those ideas now. So in terms of injections, we've got different types of injections. We've got government spending. Okay, so government might come in and it might spend money in this economy. It might invest money in the economy. Second, we've got export revenue. So when firms in this economy might not just sell goods and services to households in this economy, they might sell goods and services to foreign consumers too. Okay, and that's export revenue. That's an injection because you follow the money. Think about where the money is going. The money is being injected into this economy. And lastly, for injections, you've got investment. So for some maybe foreign direct investment, maybe it's firms that borrow money and inject it into their firms to make them grow. So we've got this idea of investment. So these together make up injections into the economy. Okay, and obviously if these injections are big enough, that makes growth in the economy better, doesn't it? However, on the other side of things, we don't only have things that are, we don't only have capital that's injected into that economy, but we're also drawing money out of that economy as well. It's not always circulating around and around and around. We might use it for different things, and some of the things that we might use it for are very straightforward here. Look at these withdrawals. Okay, money that's leaking out of the economy. Okay, we might have a withdrawal called tax. We can consider a bit later on, when we look at the multiplier, what is the marginal propensity to tax? Okay, how much taxation is being taken away from these areas here when households get paid for their factor payments? How much tax is being taken by the government? Or when consumers buy goods and services, how much taxation is being taken away by the government? Or even when firms are making profits, how much corporation tax is being taken away from them? Next, import spending. So households don't only buy goods and services from firms within the economy. They may choose to buy from foreign companies. Okay, and therefore they are spending their money. The consumer expenditure is not staying in the economy. It is leaking out of the economy to a foreign economy. So we see, and lastly, we see that not all consumers will take this factor payment and spend it directly on goods and services. Okay, this level of consumption is likely to be restricted a little bit if they choose to save some of their income. Okay, and of course we can think about what is the savings ratio, what is the marginal propensity to save, what is the marginal propensity to import, or what is the marginal propensity to tax. And these sort of things start to give us an idea about the multiplier effect. Okay, and we can start thinking, okay, so what is the marginal propensity to consume? What is the marginal propensity to withdraw? Okay, and that'll give us some ideas a bit later on about what this means for the economy as a whole. Okay, I think we'll leave it there for the moment, but just take a look at that. Try to think about what that means in terms of how an economy is structured, how money is flowing around an economy. Okay, and don't forget, we're going households, providing factors of production, factors factor payments are being paid to households. Then consumer expenditure is being used to buy goods and services. But don't forget, some of it will leak out and some of it will be injected in there. Okay, that's all for today. Like and subscribe.